Nick, how would you define infrastructure?
Thanks, Jenna. So we broadly agree, although we shave some of the edges off. Our business began from trying to replicate private markets infrastructure strategies, and so we take a very strong focus on core infrastructure. So anything that has commodity price exposure, we tend to exclude from our investment universe. Anything that has a retail-like exposure. So, if you're a communications or wireline business like a Verizon or a Vodafone, you're exposed to customer churn and kind of a retail aspect to the business. And so we tend to exclude those companies. So what we're really looking for is companies that have very stable cash flows over a long period of time. And that lends itself to the utilities, as Josh mentioned, gas, electricity, water. For us, really, we're talking about the poles, the wires, and the pipes. And then on the GDP sensitive side, the true infrastructure, anything that's involved in moving people or goods around the economy. So as Josh said, on the transport side, the roads, the rail, the ports, the airports, and we will extend into some of the communications infrastructure, but we really tend to stop at the wireless tower businesses at this stage. So again, what we're looking for is long-term, stable, and predictable cash flows that are generally inflation linked. They're going to provide those steady returns to investors over a long period of time.
And the different types of infrastructure and the infrastructure that we need today is very different than the infrastructure that we needed 10, 20, 30 years ago. Nick, how would you say that infrastructure has evolved over time?
Yeah, so that's an interesting question. Our view generally is the core infrastructure hasn't changed that much. I mean, the way we use it changes. If you think back over time, you take roads as an example. The nature of the roads hasn't really changed. And at one stage, we had horses and buggies. Okay, the road's got an upgrade, and we've got cars, and soon we'll have autonomous electric vehicles. Um, but the nature of the road hasn't really changed. We have learnt to use them more efficiently. So, for example, in the US now, we have these things called hot lanes, where you get variable pricing, and so at peak hour they cost a lot more to utilize, and off peak hours they're a lot cheaper, and it's a way of managing traffic flow and things like that. Similarly, when we think about our electricity network, if we roll forward in time, public policy is directing us towards essentially decarbonizing our economies. And that's broadly meaning move everything that we can to electricity and then power the grid with as much electricity as possible. So, the poles and the wires aren't going to change. The way we use them will change. We'll become a lot smarter. It used to be in the old days that electricity only flowed one way. Well, going forward, it may flow both ways. For example, you may draw electricity to charge the car in your garage in the future, but at a point in time, your car may actually be the supply of power, and you may sell electricity out of your car battery back into the grid. So this bidirectionality will become important over time, and that obviously changes the tech and so on that's in the network. But broadly, we're still poles and wires, and that will be the case for quite some time to come. I think, Jenna, when investors are thinking about investing in infrastructure, it's really important to understand that the returns for these companies are generated from their asset base. So it's really an investment in real assets and an understanding as to the return profile those assets will provide over time. So, whether we're talking regulated companies, particularly in the utility space, concession companies, a lot of those in the transport space, or as Josh mentions, some of the wireless towers with long-term MLAs or contracts for use of that tower infrastructure. Really, the companies that are going to do well over longer term are those that are able to invest in their asset base and earn an appropriate return. You're unlikely to earn super returns in this space because there's a lot of regulation, because you're an essential asset or a monopoly. But ultimately, what we're looking for is steady earnings, cash flows, and dividends generated from a growing asset base, and a regulator or some sort of contract that is giving us confidence that we're going to earn an appropriate return over a long period of time. So as we think about technological change, our view is it's important to consider core infrastructure and those physical assets, and will those physical assets continue to be utilized into the future?
And infrastructure really is core, with the recent events in Texas exposing some of those vulnerabilities in America's infrastructure. How do you see the country moving forward to remedy these issues?
Well, there's substantial investment required in U.S. infrastructure. Period. There has been a long, decades-long time frame where there's been underinvestment across water, across electricity. Gas has been catching up, obviously, with the energy renaissance over the last few years. But there's simply an incredibly large amount of capital expenditure required to rebuild and refurbish a lot of existing infrastructure, and to build out a bunch of new infrastructure. As Josh mentioned, the renewable sector in the US is going to spend billions, hundreds of billions of dollars over the coming decade to build out more renewable energy, be that onshore wind, offshore wind, solar. There will be a lot of batteries used by utilities to kind of manage the load on the grid. And situations like Texas most recently, or California fourth quarter of last year, we have some challenges around the variability and volatility of weather, which plays a significant role in the amount of, say, electricity that we utilize. So we've got to spend a lot of money to improve our grid resilience. And when we look at those developed markets, Jenna, we've got the regulation in place to manage private capital going into the infrastructure space. And the publicly listed companies are some of the biggest sources of private capital into the infrastructure space. Governments really don't have the headroom on their balance sheets post-pandemic to undertake a lot of infrastructure projects. They need to stimulate the private sector to provide capital and provide an appropriate return on that capital for private sector investors like us.
Yeah, and on this topic of infrastructure needs, Nick, is an infrastructure bill in the U.S. more likely now with the Biden administration in the White House? And what kind of opportunities might an infrastructure spending bill offer?
Yeah, listen, I think it is more likely. It largely has bipartisan support at a conceptual level. Obviously, the devil's in the detail with these things. And if we think back to the Trump administration, he obviously had desires around the infrastructure side. The plan was to spend $250 billion of federal money to stimulate around $1.25 trillion of investment into the space. So it was kind of $250 billion by the feds, $1 trillion from the private sector. Kind of a 4-to-1 ratio there. So the Biden bill is rumored to be somewhere between maybe as high as $3 trillion, and that's going to be a pretty significant investment. And you can expect that there will be some leverage on that. There'll be a lot of private sector involvement as well. And so, as we mentioned before, we have regulatory arrangements in place to support the construction of new infrastructure assets, and to manage the process of raising private capital, building the project, and then earning a return on that project from a number of consumers of that product or that project. And so we can expect a large amount of private capital to flow into infrastructure. And Biden has targeted a number of areas. The water infrastructure that Josh mentioned before has been severely underinvested in, and 85+% of that water infrastructure is owned by local munis. So there are, again, frameworks in place to transfer those assets into the private sector and have the private sector invest a lot of capital in those. We're also looking at investments, obviously in the renewable space. There is electrification of some of the freight rail networks in the US that's being targeted, and a lot of infrastructure around 5G and the rollout of 5G networks. So that goes to the wireless tower businesses that we discussed before as well. Jenna, when we talk about the implementation of these infrastructure packages, and Josh, we've been talking about the US, Europe, most developed countries around the world, and a lot of the emerging markets are looking to stimulate their economies with an infrastructure build. And the reason for that is that you're using local aggregates, you're using local labor supply, contractors, and so on. So as Josh said, there's a multiplier effect for every dollar that you put into that project that ripples through the communities, and that then allows to raise their living standards within particular communities as that project is being built. And then you hope, if you're building the right projects over time, that means the economy is more efficient. Goods, services are able to trade more freely with less friction, and that should give an ongoing GDP benefit from that infrastructure build. So it's kind of a double whammy. You get the GDP benefit from the construction of the project, and then you get an ongoing, what we call an efficiency dividend. And in that context, the public sector has a very strong role to play in terms of directing which projects they want done. The private sector is generally better at the construction side of it, and getting those delivered on time and on budget. And as Josh and I look at the market, we see a number of the listed companies being incumbent players in their geographic regions, particularly across transport and electricity and so on. And so they will be the beneficiaries of some of the directed expenditure. They've got access to lots of capital, so we'll build the projects and we'll earn an appropriate return on those projects over a long period of time.
And we're hearing a lot about inflation with all of this infrastructure spending and stimulus and capital expenditures. Nick, do you think inflation will be an important factor to consider amid huge stimulus spending and more organic economic recovery? And how are you looking at it in your portfolios?
Yeah, it's certainly topic du jour, and we do expect more inflation to come through, at least in the near term. Most of the infrastructure companies have some direct or indirect link to inflation over time. Direct, particularly in UK, Europe, down through Asia, where inflation becomes actually a pass-through for the infrastructure companies. Indirect, particularly in the US, where there's a lot of nominal return targets. And so as inflation goes up, the next time you see your regulator, your nominal return target actually increases. And so there we talk about an indirect link to inflation. So as we look at our portfolio, for example, in our income strategy, more than 90% of the exposure of the portfolio has a direct or indirect link to inflation. So for infrastructure companies, inflation is largely a pass-through. It's one of the very attractive features of investments in infrastructure. We will also see that inflation play into bond yields, and we've obviously seen that recently over the first couple of months of 2021, and that will continue, we think, until bond yields reach a more viable long-term level and kind of an equilibrium in the economy. So broadly, inflation is a pass-through for the infrastructure companies. So we're actually positively correlated to inflation. And as you think about how inflation plays into the economy itself, you're going to end up with higher bond yields, which is one of the key valuation metrics for infrastructure. That will provide a bit of a headwind for some of the more defensive utility investments as those bond yields are normalizing. But actually, it's more of a tailwind for the transport and the more GDP sensitive infrastructure, particularly if those bond yields are rising because people think the economy is getting better, which will be the case this time.
Going back to the point on utilities, Nick, some people might think that they already have a significant exposure to infrastructure based on their utilities holdings and say the S&P 500. Is that a fair assumption?
No, not today. So if you take the broader category of infrastructure, utility, the transport companies and the like, you're looking at less than 5% of the S&P 500. So if you have a general equity exposure, yes, you have a little bit of infrastructure exposure, but really, not a sufficient amount to provide that infrastructure investment characteristic to your portfolio.
So, how does infrastructure fit into the portfolio?
We find that clients are using infrastructure as essentially as ballast in their portfolio. So it's a more defensive category. It's a longer term real asset with inflation protection properties. And so as a result, people are often putting infrastructure alongside, say, REIT exposures in their portfolio to provide that real asset inflation linked kind of defensive component to the portfolios. What's been interesting, through the pandemic, and if you go back to the GFC, similar occurrences there, the REIT sector was a little bit more pro-cyclical in a significant downturn. And that's because, the REIT companies tend to have their vacancies go up when a recession occurs. They need to increase the level of incentive payments to get new tenants to come in and so on. And so they tend to be more pro-cyclical than infrastructure, which really generates a return on the underlying asset base. So as long as the companies have access to capital and with the amount of liquidity being pumped into markets, that's a given, they can continue to invest in their asset base. And as they grow their assets, they grow their earnings, their cash flows, and their dividends.
And looking more closely at various opportunities, Nick, how would you characterize the opportunities for infrastructure investors in the developed world versus the developing?
So in the developed world, we are spending and need to spend a lot more money refurbishing existing infrastructure. And that's the poles, the wires, the pipes, the roads, the bridges, and so on. And as we refurbish that, we will add a little bit of technology to a lot of that infrastructure to, improve the flow of electricity and add battery stacks into our utility networks and so on. But the focus is really on the refurbishment first, and then building out of some of the bells and whistles in the infrastructure. In the emerging markets, it's a lot more about the growth of the underlying economies. So we've got economies growing at rapid rates, higher rates of inflation in the emerging markets, and you've got significant both population growth and populations becoming more wealthy as those countries are emerging. And as those populations become more wealthy and reach middle class, they want to own a car, they want to own a house. So you need more infrastructure to support the development of those of those populations. And then once they reach another wealth level, they want to start traveling. And so you need more airports and so on. So in the emerging economies, it's about kind of growth of the underlying economy and supporting the population, both growth and as they become more wealthy. In the developed markets, it's more about the refurbishment of the existing infrastructure is where we've got to spend a lot of our money.
And going back to green infrastructure, Nick, how would you characterize the opportunity for infrastructure given what seems like a synchronized focus on climate in the US, Europe, and China?
In short, it's substantial. The International Energy Agency, which does a forecast of infrastructure spending in the energy sector, in particular, focused on renewable energy and a decarbonised economy, is forecasting, based on current public policy, $800 billion US a year over the next 20 years, and really focused on the poles and wires and pipes space. Now, there's additional over and above that to actually build out new renewable energy and so on. Their view, if you move to a path that sees all countries meet their obligations under the Paris Climate Accord, that number's north of $1 trillion a year. And again, that's just on the poles and wires and pipes, and then we've got additional on renewable energy and so on. So there is a huge amount of capital to be spent. Thankfully, we've got great liquidity and access to that capital in the listed markets, and we have those regulatory frameworks in place to help ensure that A, the assets get built on time and on budget, and that B, the investors in those projects earn an appropriate return over a longer period of time. So the question then becomes, well, as an investor, how do you think about investing in that thematic? And it really comes down to your time horizon and what you're looking for infrastructure to do in your portfolio. The more stable ballast like you want in the portfolio, the more you should own those poles and wires and pipes, which are going to earn a steady return over a longer period of time. The more sizzle you want in the portfolio, well, there are some other investment thematics as technology developments around the battery space, and significant build out by renewable companies. Some of those returns will be competed away, so there is some element of risk in some of those companies. But think about that broader thematic providing a tailwind for infrastructure investment and infrastructure returns for at least the next 1 to 2 decades.
Nick, are there any infrastructure areas that you're excited about right now that maybe aren't making headlines just yet?
Yes. So, the listed market as well as the private market for infrastructure is interesting, Jenna, in that it's it's a big market. Our opportunity sets over $2.5 trillion market capitalization. But when there's flows moving into the space, for example, the ESG thematic and how that's playing out in infrastructure, you tend to see mispricings in the market. And the same thing happens in the private markets, as Josh has mentioned. They're targeting the mid-market and below. For a lot of the larger deals, they're becoming very expensive, and it's simply the weight of money, capital chasing specific ideas. And so what that says to us is, as an investor, if you're looking at this space, think about doing some work with specialist investors like Josh and I, because we're across the market on a global basis, and we can take our capital where the opportunities are. And when you look at what has happened over the last 12 or 18 months, there's been a significant amount of capital follow that ESG thematic into renewable energy, and there are very high growth expectations there. But a lot of that capital has moved out of boring old fossil fuel type companies, to the extent that at one stage last year, the markets were pricing the midstream pipeline companies that Josh mentioned earlier on the basis that they would all close down within 10 years. Well, we're going to need gas and rely on gas as a bridging fuel for at least the next 2 or 3 decades. And so there are opportunities that arise in the markets that really don't hit the headlines, that you have the ability to buy into a solid set of underlying assets that have got long-term cash flow generation, generally backed by regulation or by contract, and you can have great confidence that you're going to earn a solid return on that investment over a longer period of time. So gas is one area that's interesting. Josh has discussed the wireless tower companies and the build out of 5G infrastructure. That is a global phenomenon. There is significant capital that will move into that space over time, and it really gets government and public policy support, because governments see it as a way to close the inequality gap within their communities and their countries. When you think about where that goes over time, the Internet of Things has been bandied around a lot, and so you take that household. It's not just going to be a personal computer or a cell phone. It's going to be connected refrigerators and other appliances, and that may be to aid online commerce. It may be simply for maintenance. These things identify a fault and they automatically call a technician out to resolve, or they download a firmware update or whatever the case may be. There are literally thousands of use cases for 5G infrastructure and that connectivity that it provides.
And the pandemic has undoubtedly accelerated a lot of these technological trends. Nick, how are you approaching your balance of economically sensitive and defensive infrastructure exposures during the pandemic, especially given all these changing mobility restrictions?
Yes, great question. So we were pretty defensively positioned, which meant we held a high weight toward the utility companies this time last year, and that was because we felt we were getting later into the business cycle. Obviously, never foresaw the pandemic. What that allowed us to do, though, was to first of all, trade some of our higher quality exposures that fell less as the market corrected into specific names that had fallen a lot. Maybe they were heavily owned by hedge funds, and the hedge funds had to get out, so the stock sold off a lot. That happened to a lot of the US utilities. And so we did things like we traded out of some of our Canadian utilities and we bought US utilities at deep discounts. And that was a great trade for the portfolio. And then we turned our mind to, okay, what does the reopening scenario look like? And what we were able to do then was to actually spend a lot of time talking to the companies and think about how economies would open up over time and where the investment opportunities would arise. And that's because in March of last year, pretty much everything sold off. And the first place we went back to was the toll road companies. And the reason for that was, obviously economies went into lockdown, but as they came out of lockdown, people were concerned about using public transport. And so more and more people drove in their cars. And so the traffic came back on the toll roads much faster than the market was anticipating. We expect for most toll roads around the world, they'll get back to 2019 traffic levels late 2021 or into 2022. Airports, on the other hand, the air travel was always going to take a lot longer to come back. And so we've been very cautious around the airport space. And ultimately, we won't get back to 2019 traffic levels until sometime between 2023 and 2025. So there's a long recovery timeframe there. So what that allowed us to do in the portfolio was shift from the more defensive positioning, which was in our balance fund, more than 70% of the portfolio, and in our income-oriented product, it was 90% of the portfolio, and selectively take some transport and some GDP risk, or that reopening risk, in the portfolio. And so we shifted about 10 or 15% of that weighting in the middle of 2020, and we added an additional 10% in Q4 of 2020, and that's really been a great trade for the portfolio to kind of get exposure to this reopening trade as people start to use the infrastructure again.
Nick, how are you diversifying and being prepared for various risks that could arise?
We've diversified the portfolio geographically, so across different regions, and as Josh mentioned, regulatory risk is a key issue for infrastructure. You can't avoid that because it's the nature of the space, but what you can do is diversify that risk by taking exposure to different regulatory regimes and regulatory environments. In the US, regulation for the utilities is all state-based. So you can diversify across states and remain within the US, or you can move capital into Europe, UK, Asia, Australasia, and Latin America, and you can gain exposure to a number of different regulatory regimes that are all totally independent. They also work on cycles. So anywhere from 1 to 2 years in the US, out to 4 and 5 and even 10 years in other parts of the world. So you've got that ability to diversify your portfolio across geographic regions. Then we also looked at the sector basis. So I talked before broadly about that defensiveness of the utilities versus the GDP exposure of the more infrastructure companies. There's obviously nuances within that, as Josh has pointed out, and so you have the ability to diversify your portfolio across sectors to gain more exposure to economies that might be growing or have higher inflation, and pick companies that have that inflation pass through. and benefit from that higher growth profile. So, exposure to some of the Chinese infrastructure companies, as an example. So there are a range of ways that we can take exposure to different both macro themes and infrastructure thematics across the globe.
And Nick, as we wrap up this panel discussion, any final thoughts on your end?
Just from an investor perspective, I wanted to reiterate, the importance of thinking about how this works in your portfolio and what you're looking for it to do inside of your portfolio. And as we think about infrastructure, we think about investing in real assets or hard assets that have a long life, 20, 30, 40, 50 years life, that are going to generate an appropriate return over that time frame, and that return being backed by either regulation, concession, contract, or the like. And that ensures that we have growing asset bases and therefore growing earnings, growing cash flows, and growing dividends with some level of inflation protection.